This is Pranav Rao from Smartkarma, and I'm pleased to have with me Victor Galliano to discuss his views on Japanese mid-cap banks. Victor, appreciate your time today on the 12th of August. Why do you like Japanese banks in this current environment, Victor?
Yes, I think what we see with the Japanese banks is clearly that they're key beneficiaries of the Bank of Japan coming out of its zero interest rate policy, something that's been ongoing for over a year now, and it's fairly slow progress. But what we've seen with this as well is that there's also been a steepening of the Japanese government bond yield curve, which is very positive for banks. And over the last few quarters, we've seen net interest income rising. So we look at the banks and we look closely at those banks that have the best gearing to benefit from the rising interest environment. So those that have a pretty chunky share, mainly of floating rate notes, or have a lot of fixed rate on very short term that can reprice in this environment into a higher rate climate, really. As well as that, also what we've seen is the banks benefiting from the push by Japanese Stock Exchange and also by the FSA there to better corporate governance. And what this is doing is it's getting the banks to focus on their cross-shareholdings and how they can unwind those. And that should really benefit shareholders, either in the form of higher dividends or one-off share buybacks, things of that kind, or recycling those resources into the core banking business, which should be higher return going forward, given the environment of high interest rates. Also, I think it's worth mentioning that the banks have relatively clean balance sheets in terms of their NPLs. There are exceptions, and there are some banks that have run into problems, and we can mention those at the end. But yet, generally, they're in pretty good shape.
Got it. Understood. Very interesting. In a recent note, Victor, you highlighted a preference for Iyogin Holdings, that's 5830JP. Could you share some of the key reasons to kind of call out this name?
Of course, yeah. I mean, I think the key points there really are, when you look at this, the cross-shareholdings, one of the things that really stood out for me was that in terms of its valuation of price to tangible book value relative to the value of those cross-shareholdings as a percentage of its market cap, was relatively high. Price to tangible book value was low, and you can see clearly in our report from our chart, figure 2, that it really does stand out. And it had its value of its cross-shareholdings relative to market cap was over 60%, over 65% at the time of publication, and currently still over 60%. The other banks in that group, the highest would be around 40%. So there's quite a wide margin there in terms of the potential to unwind those cross-shareholdings and basically benefit shareholders. In addition to that, Iyogin also has about 60% of its domestic loan book focused on floating rate notes. So on floating rate lending, So on that basis, it is a key beneficiary of the rising interest rate environment, and it has a pretty clean balance sheet as well, low NPL ratio. Those are really the key points, and attractive valuations as well. So it's well geared to the rising rate environment there.
Got it. All sounds very positive. If we had to kind of look at this from a slightly different lens, in this environment, what Japanese banks or financials might you think are avoids?
Yes, I think something I'd be quite cautious in is it's a name we've written on in the past individually and got into quite a lot of trouble in 2024, which was Aozora Bank. The shares have been recovering. It does have quite high gearing into the interest rates. I will give it that, and you can see that from our report and one of our charts in our report. But one of the issues there is they got themselves in quite a pickle with exposure to US CRE, commercial real estate, and that came through in a much higher NPL ratio than the peer group. They're still working that through. That's a potential drag to the bottom line, because obviously that implies that your cost of risk is going to be higher than the peer group. They are getting that down, and this is one to revisit further down the line. But for now, I think even though the shares have been recovering, it's been a poor performer year to date, and I think it will continue to lag the peer group in the foreseeable future.
Got it. Very interesting. Thanks for the call today, Victor. And listeners, do check out Victor's coverage of banks and financials on Smartkarma and tune into our next Smart Call. Thank you.
Okay, thank you, Pranav.